Hello and welcome to Market Domination. I'm Julie Hyman. Jared Blickery in for Josh Lipton today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
If those enterprises and those consumers aren't paying more for those new AI features, then this whole gravy train comes to a screeching halt, like we saw in the internet bust.
Picking the top in any particular run is always difficult. You know, we want to be invested here. The market we think will be higher than where we are right now at the end of 2025, but we think we'll probably have a bumpy road that'll provide some opportunities and equities between now and then.
I'm a little frustrated that we are not seeing a recovery. You know, that's partly due to the delay in the rate cut decision by the Federal Reserve. What's striking is all-time high in the median existing home price. So we are now seeing some acceleration in prices. Multiple offers are still happening in the marketplace. Maybe one welcoming news, potentially a poor leading indicator in the future, is we are getting more inventory.
We've got 1 hour to go until the market close, so let's take a look at the major averages, Jared. We are not seeing a heck of a lot of movement today. The Dow, very little change, very slightly to the upside.
And it is opposite the Nasdaq today, same as yesterday.
And yeah, exactly. That's what we've been seeing, not just opposite, but outperforming.
Yes.
Frequently, we've seen it the other way around with that divergence. The S&P 500, little change slightly to the downside, as is the Nasdaq. You and I have been closely watching that S&P equal weight index.
Yeah, the mega caps versus the, I don't know, the soldiers, the generals versus the soldiers.
Exactly. So should we be looking at a 5-day chart this week, or should we be looking at a 4-day chart?
4-day. Let's do a
4-day chart because of the holiday shortened trading week with the S&P. You were talking about this earlier.
Yeah, so the S&P 500 equal weight is up almost 1%. Now take a look at the S&P 500. That is up 62 basis points, but there is a difference there, and that's something we've been tracking. You know, you have the S&P 500 market cap at record highs, the Nasdaq at record highs, but the Dow has been languishing. The Russell 2000 has been languishing, the transports. There are a number of indices that just have to catch up. So we'll see how this proceeds next week.
Yeah.
But we're not done today, are we?
No, we're not done today. If I can get us back over here, because I wanted to check on yields also to see what we're seeing there, because we've had a lot of economic data this week. It's been relatively mixed, but today we did have the PMIs that came in better than estimated, and we also had existing home sales pretty much in line with estimates here.
Not a whole lot of movement.
Nothing happening in the bond market, but on the week, we've seen, well, I guess not that much movement over the course of the week.
So kind of a reprieve in a holiday shortened week. Maybe it's a good thing that we don't see too much movement in the bond market. That has been a trouble spot for equities when we do see too much action, but not today.
Yeah, and then let's look at the sectors as well here. We've got financials lagging a little bit, utilities lagging a little bit, communications and services and discretionary higher.
Let's check out the Nasdaq 100, because that could be an alphabet story, which is up 2%, and also, guess what? Nvidia down 3%. Yeah. That's tech, but we'll talk about that as well.
Well, and one other thing I just wanted to note as we look at Nvidia, as we talked about earlier today, you helped me a lot in understanding the whole witching situation, which I've obviously covered for years, but we dug a little bit deeper. And Nvidia in particular has an enormous number of options that are expiring
bigger than anything
today.
Else in the market.
Right.
Almost as much as the indices, which is crazy.
So as you noted here, we saw over the past couple of days, it's sort of like stalled out around 140, and that's when the stock really started to fall.
And guess where those strike price, where that wall was, where you had that huge open interest, 140. So that's not a coincidence on OPEX day.
Yeah.
All right, Wall Street went bullish this week with multiple firms upping their end-of-year outlooks. One of the strategists raising their year-end price target for the S&P 500 is Julian Emanuel, Evercore ISI's Senior Managing Director of Equity, Derivatives, and Quantitative Strategy, and now he joins us. Julian, you made a lot of waves this week, so just give us your thesis here. Street high target on the S&P 500, 6,000. Wow.
Well, so I guess let's rewind back to 2023. We have been big proponents of generative AI the enablers, obviously the stock that was, at least for a brief moment or two, the highest market cap stock in the world this week, perhaps to be again shortly, as well as the companies that have been actually taking the AI technology and using it to control costs, to get better connected to their customers, and to build a competitive moat. And frankly, when we think about this, this is a theme that has a lot more legs. Obviously, the excitement has been in and around the enablers, as we discussed. But to us, when you combine that with a Fed that's also willing, seemingly, to cut rates if it's able, not necessarily if it has to, i.e. an economic downturn, if it's able, given inflation continuing to moderate. And the idea that expensive markets have a unique history to themselves is that very often when a market gets expensive, and this one basically did, crossing 20 times trailing earnings back in January, the history of expensive markets is that they last a year and a half to 2 years in duration and can rally anywhere from 40 to 60% additionally. This one, as I say, is 6 months old and up around 11, 12%. So we think there's more to run.
Yeah, I just want to emphasize, Julie, and it's Julie here. It's great to see you. I just want to emphasize that last point a little bit because I thought it was such an interesting one. There are people all over the place who say valuations are too high, either in specific stocks or in the market overall. But just to linger on that point a little bit, just because valuations are high is not in and of itself a reason for them to come down.
No, that's right. It basically, what we're looking for is sort of the tail ends of the distribution of things, of reasons that stock prices can come down. On the one hand, there's what you would call the bubble watch. We don't see any of the incipient signs of a bubble forming. No IPO or M&A mania. Sentiment, by all the readings, continues to be reasonably subdued. There aren't any egregious policy errors. The Fed isn't, saying we're going to cut no matter what. They're being prudent about their approach. And so for us, on the one hand, that's okay. And then on the other hand, the recession watch, which really is ultimately the thing that destroys bull markets for the most part. Yes, the economy is slowing. It is, in recent weeks, started to become more noticeable. But when you look at something like the weekly jobless claims numbers, still averaging 240,000 a week, that's nowhere near recession red flag signs. So we see, just more runway for higher prices. And that's basically how we get to 6,000.
And let me ask you about the Fed. How does that enter your calculations? Of course, they're on pause, and they've been really talking up the possibility of a rate cut, almost to the exclusion of all this data dependency. Where do you think the Fed goes from here? And is it possible that they end up in a policy error, policy mistake?
So Jared, what's fascinating about the Fed is, if you think about it, we came into the beginning of the year basically looking for 6, maybe almost 7 cuts at the peak, then got down to expecting only 1 cut, and now it's sort of 1 to 2. Our firm thinks that you're likely to have 2 cuts. But the point here is not that they're going to cut, how many cuts they engineer in 2024. It's much more the market's confidence that the Fed's going to do the right thing. Okay, so we've been obsessed while inflation remained very elevated, basically a year ago, that the Fed was going to cut while inflation remained too high. Well, they've been cleared that they're going to be patient. And on the other hand, they've also said that if the economy starts to slow, they have the runway again because inflation has been coming down. So it's not a question of how many cuts. There will be cuts eventually. It's just that the market is more confident that there's enough runway for there not to be a policy error in either direction. And I think that's where the enthusiasm is coming from.
Julian, I want to come back to tech a little bit here because you also upgraded that sector to outperform from in line. I have to acknowledge here that if you were in line, you missed out maybe on some of the upside. You know, the Infotech Index is up, 29% or so year to date, but it also obviously implies that you think that run is not done here. You talk a lot in the note about AI and the prospects there. Is that really the central case for more upside for tech?
It certainly, look, we go back the last 30 years, and there's no getting around the correlation of tech outperformance to stock market outperformance. Most of the best periods of returns have had tech outperformance. And look, we can be faulted for not going all in on the group as a whole. We tried to and think it's still very valid that in an environment where correlations are as low as they are, that you pick stocks rather than say, you know, this sector, that sector. Obviously, we do that because that's part of our strategist's job. But when you think about it, particularly in comparison to sort of the bubble around Y2K, you're seeing a greater percentage of the market's earnings coming from tech. And again, the whole concept of AI implementation, we think the critical years are the next 2 years where we think we're going to see more broadly tech continue its earnings run.
Julian, in addition to your purview, which is broad, you also have an expertise in derivatives. So finally, I want to ask you about witching. You just heard us talking about it, and in particular what we've seen in Nvidia the past couple of days, a little bit of a rollover in the stock. Is that just sort of a technical options related move? Do you think it's the start of a bigger correction in shares of Nvidia? What do you think's going on there?
Well, those shares, you've had sort of these massive reversal days every time and again over the last year. Yesterday was one of them. And I think what's interesting to us is the bigger message, right? You're down around, I don't know, call it maybe 11% from the intraday high yesterday. And the broad market has barely moved. Before I started talking, you were talking about how the equal weight index is outperforming the S&P 500 here. And that's really positive, given the fact that the acknowledged market leader has stumbled here. Look, again, if you talk to our fundamental analyst on the name, he thinks you could get to a market weighting of between 10 and 15% between now and 2030. And that's obviously based on the promise of AI. But look, the fact that these kind of short-term potholes in a name that's moved this far, they are to be expected. And the idea that the market is actually taking it in stride is very, very positive.
And Jared tells me that's what we call bearish engulfing candles. He's very excited when you bring up something like this. Julian, always a pleasure to talk to you. Thanks so much.
Thank you, Julie.
We're just getting started here on Market Domination. Coming up, according to reports, Boeing is getting closer to buying back Spirit AeroSystems. We'll discuss the news and check in on some of today's top 10 trending tickers on the other side. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We'll take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, more Market Domination on the other side. Time to check in on some of today's top trending tickers, starting with Sarepta Therapeutics. That's after the FDA approved its muscular dystrophy drug. Yahoo Finance's Anjali Kamlani has been tracking the news. She joins us now for more. A little bit unusual here how this unfolded.
That's right. It sort of got there step by step and bit by bit. Sarepta getting that full approval yesterday from the FDA after a long journey with the clinical trials. We still are waiting for further confirmation. They are on the clock for a confirmatory trials. So just to recap what happened, they got the full approval for anyone 4 years and older, especially those who are mobile or who can walk. It's called ambulatory. Meanwhile, there's limited approval for those who are 4 years and older who are bound to a wheelchair or non-ambulatory. And those are the ones that there still is a confirmatory trial needed for benefit. So this approval was also kind of controversial in the sense that, the top leaders of the FDA there really went against their experts in order to approve this because the drug hasn't yet proved that it slows the progression of the disease. And that's the thing that experts are kind of worried about. Meanwhile, we know that the drug has already been on the market with limited approval or accelerated approval since last June. It's already raked in a lot of money for the company, about $330 million since last June. There you see it on your screen, and $134 million in the first quarter alone. And that's when the insurers as well as Medicaid started covering it. So we know that really boosted the product, and it accounts for 40% of Q1 revenues and is just one of 4 products that Sarepta has on the market. So really, they have the bulk of the DMD products there.
Wow. Very quick follow here. It's an expensive drug as well. Why so expensive?
So when you think about it,
$3.2 million?
That's correct. And it's a one-time infusion. So that's the way that drug companies think about the way to price things is how often is it needed? So what kind of benefit you're getting out of it? And there's this term that they love to use called value add or to your life. So what is the value that you're adding to your life? How much productivity are you getting through your lifespan from this drug? And we have to remember that DMD tends to affect men. It also affects younger men, and the lifespan, the life expectancy is in the 20s to 30s, and so it does affect younger individuals. So that's where the cost comes from.
Interesting. Thanks so much.
Thank you for that, Anjali. And moving on to reports of Boeing's deal to buy back Spirit AeroSystems. Spirit stocks rose today as Boeing's negotiations with its hull producer may be coming to a head. And this is kind of a roundabout here, coming full circle. Boeing used to own Spirit about 20 years ago, and we know that Spirit has just had a really rough time since those 2 crashes, which were, I believe, in 2019 with Boeing. And you take a look at the charts of either company, they really just kind of fell off a cliff there. And because Spirit is such a big part of Boeing's business, or excuse me, the reverse, because Boeing's such a big customer with respect to Spirit, they're just having a tough time. And then you throw in Airbus as well. I don't know, I've seen mixed reactions among analysts here.
Right, well, Airbus is reportedly getting closer to an agreement to buy some of Spirit AeroSystems business, which would then, in theory, pave the way for Boeing to complete this acquisition of Spirit AeroSystems to sort of shore up its supply chain. One other detail of this that is important is that the CEO of Spirit AeroSystems, Pat Shanahan, is one of the prime contenders to become the next CEO of Boeing. So presumably all of this getting sewn up would also help with that quest, if indeed he's going to be the guy who will eventually be tapped.
One more quick note on Boeing. They are expected to evade criminal charges now for violating their settlement. So this is a deferred prosecution agreement. This could have been a company killer because I've seen comparisons to Enron and Arthur Andersen in the past, but that is now passed because they get this deferred prosecution agreement. So the stock price would be much different if this had gone a different way.
Very important detail. Let's talk about Smith & Wesson. That is another stock that we're watching today. The shares falling after the gunmaker warned of weakening demand in the current quarter. Last quarter, which was their fiscal fourth quarter, actually was pretty good. They beat estimates. We saw sales there rise about 10%, but the company now says that in its fiscal first quarter, sales are going to fall 10% year over year. And we recently had the chance to talk to Stephen Gutowski, founder of The Reload, which covers the industry, and he talked to Yahoo Finance about why we may be seeing this lack of demand.
2020 was such an unprecedented record year in gun sales that we may still be experiencing a come down from that 4 years later. People may also not be as worried about new gun bans because of action by the Supreme Court in 2022 as well.
So that helps explain a little bit about why Smith & Wesson might be coming out with this kind of guidance.
I mean, that was kind of the argument back in the day for so many companies that demand was being pulled for a bunch of services and products. But let's go to the Wi-Fi Interactive. I have a Smith & Wesson brands chart going back to the last century, the last millennium. But these peaks are really interesting when they coincide what they coincide with. This here is the global financial crisis, 2008 or so. Then we have the Trump election, very contested election there. Then we have the pandemic here, that's 2020, another election, and you can see that these spikes indeed getting bigger. So you got to wonder what's going to be the next catalyst. I don't know, and maybe it doesn't have to happen, but it's not surprising that after you have one of these peaks that you do have a lull in the action. It looks like these last multiple years, these cycles.
Well, the presidential election maybe would be the next catalyst, potentially. It tends to be for some of these gun buying trends. Let's broaden it out and talk about what's going on in the market today based on some economic data. The Purchasing Managers Index for June coming in better than anticipated. We're not seeing a big movement in stocks on the back of that. We have had Treasury yields moving a little bit, but not terribly much in today's session. Let's sort of look at what we've heard this week in terms of economic data. We're bringing in Michael Reed, U.S. economist at RBC Capital Markets. The data seems to be, Mike, going in a similar direction that it has been recently, which is most of the inflation data continues to indicate some moderating. Most of the sort of growth indicators seem to be okay. Maybe retail sales would be the exception. I mean, what's sort of the big takeaway from all of these numbers?
You know, for us, it's been a continued sign of normalization. And we're seeing that across a number of metrics. As you mentioned, we saw retail sales come in, and if you look at the headline number, it was a rather modest gain at 1/10 for the month. But when you look at the control group, which is an important group that feeds into GDP estimates, that was a bit more robust at 4/10, so a sign that consumers are still spending. But when you look at that in the context of the downward revision we saw in the prior month, it doesn't look quite as strong. So again, I think we're starting to see some normalization and a bit of pullback in spending in the consumer space.
And how does this relate to the labor market? A lagging indicator depends on which data points you look at, but we've seen some cracks in the labor market. Despite that, the headline numbers continue to come in pretty strong.
Absolutely. You know, there's a lot of debate around which labor market metrics to look at. And, you know, if you look at things like JOLTS, the job openings number in particular, you look at wages or the unemployment rate, they do suggest some potential weakness. Not necessarily something to worry about, but signs that the labor market is loosening. However, when you look at the payroll number, that is still quite robust. We're still seeing very strong gains there, and wage growth is still quite strong. So there are signs that growth in the labor market will continue.
So, I mean, this is something you recently wrote about, which I think is interesting, this question of, is the labor market still tight or not? So kind of where do you come out writ large on that?
Sure, and I think an important way to think about this is in the context of normalization, what else is going on kind of more broadly in terms of the demographic picture. And we've talked about this in terms of consumer spending, in respect to retirements and what that means for retirement assets showing up in consumer spending. But another area where it's really important is in the labor market. And there, what we are seeing is a rise in the number of retirements, and that does create job openings. So when we're thinking about where the right number for job openings should land in terms of the new normal, we do think it should be higher than what we saw prior to COVID, because we are now at kind of that peak baby boomer retirement age, and as those folks retire and leave the labor market, that creates job openings. That doesn't necessarily show up as net new job growth. That would be what we see in the payroll number. But it should help put downward pressure on the unemployment rate and keep upward pressure on wages.
Yeah, it's an election year. We've been talking a lot about the election. What kind of pressures, what do you look for in the economic data in a year like this that you might not look so hard at any other time?
You know, one thing that I think is getting a lot of attention now is trade, and especially around some of the tariffs that have been proposed or enacted. We saw Biden announce some that will be phased in over the coming years. One in particular I think to watch is the tariff around semiconductors. We have a lot of activity here in the US that is being supported by the CHIPS Act. We're seeing a lot of activity in non-residential structures continue because those fobs are still being built. We'll see another tailwind in investment in terms of equipment as that is installed in those facilities. And then once those come online, we should see a boost to employment in terms of the folks who are hired there to start the operations.
So those seem to be on track no matter who wins in November in terms of these big projects. In terms of tariffs and some of the ratcheting up of tariffs that former President Trump has promised should he re-win election, how are you thinking, especially since we got already a wave of tariffs, how are you thinking about that, those tariffs' potential inflationary impact?
Yeah, so what Trump proposed was pretty wide ranging, and we would expect to see that primarily hit the goods space. And what's concerning there is that's where we've been getting a lot of the help in terms of this inflation battle. And so, if you lose that disinflation that we've seen in the goods space, then I think you're looking at a slightly different picture for the Fed heading into kind of 2025 and thinking about what that means for inflation, their ability to cut, and more importantly, too, what does it mean for the labor market?
All right, we got to leave it there. Really appreciate you coming by on a Friday afternoon. Michael Reed.
Thanks for having me.
And up next, it's the latest edition of our series, Goodbye or Goodbye. We're going to take a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stay tuned, more market domination on the other side.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're combing through the balancing act that is debt in the retail landscape. I'm here with Chad Morganlander, Washington Crossing Advisors, Senior Portfolio Manager. Great to see you, Chad. Thanks for coming in.
Thanks for having me, Julie.
And first, we have up a stock for the gentleman farmer, for the cottage core among us, Tractor Supply.
Right.
The stock's up like 27, 28% over the past year, so it's done pretty well. But let's go through why you still like it here. The dividends are rising and the company's growing.
Yes, this company has had a long history of having a wonderful balance sheet, steady Eddie cash flow stream. So it's growing, it's profitable, very little debt, and it's a rising dividend company.
Are you a Tractor Supply customer? I'm curious.
No, but I've been in a bunch of them before.
Gotcha. I didn't know if you're a gardener. I don't know. High return on capital business model. Talk to me about that, because the company has been putting a lot of capital into its stores.
Absolutely. They have over 2,400 stores. Just keep in mind that their footprint is in rural America, right. So it's a low type of rental or ownership type of business model. And there's not a lot of capital investment that they need to put forth to get a higher return on that invested capital. It's a very steady, sturdy business model, and they've been able to grow in a very efficient manner.
And we've seen also the growth as people have been moving to some extent, right? Moving to more rural, especially during the pandemic, right?
Absolutely.
So it is people who farm for a living, but it's also people who farm or do yard work or whatever for fun.
Right. So during COVID, they got that shot in the arm as people moved away from the city life to more urban life. You would have thought that perhaps that would have scaled back, but in fact it didn't. They have roughly about 50% of their revenues come from feeding not only farm animals, but pet food. So it's a steady, Eddie, more predictable revenue stream. And we believe over the long run that will continue. They're not as economically sensitive as the next one.
Gotcha. All right, but let's talk about a potential risk, as we like to do here on Goodbye or Goodbye. And that is if we do see that shift. Like, what if all those people who moved out move back to cities?
Oh, absolutely. And we believe that will happen to a certain extent. We have modeled that out. But we think that over the course of the next 3 to 5 years, the growth rate's going to be between 3 and 6% on the top line. We're not expecting, nor do we need to make this company and this stock attractive, a robust growth rate on the go-forward basis.
Gotcha. And you do own shares of Tractor Supply?
Yes, our family does own shares.
Okay, let's get to the stock that you do not like. This one also in retail, and it's Macy's. Now, this stock is also up over the past year, about 19% or so. There's been a lot going on in terms of activism, et cetera, but you say they still have too much debt.
So Washington Crossing Advisors shies away from companies that have a lot of leverage on their balance sheet. They've got roughly about $2.7 billion of debt and then $2.5 billion or so of actual leases. That is a problem. We think that's more of an anchor, which is a real issue over the long run in a very competitive retail environment.
And that's at the same time that the company is not growing in terms of revenue. Let's take a look at the revenue chart here, because what you see here are these various things are kind of holiday seasons, right? But they're descending, and then the non-holiday times are also so in other words, they're just not growing as much.
They're trying to rationalize their footprint, and it's like a battleship trying to make a U-turn in a closet. It's very difficult in doing that. It's going to contract their top line, but the issue really has to do with such a competitive environment. They really have to find their way, and that's part of the problem. They have online retailers that are price competitive, and then they have the higher end retailers. It's a tough business.
So being in the middle is a tough a tough place to be right now.
The middle ground is a tough place to be.
And so they're exposed to those sort of consumption trends. We just saw retail sales this week, for example, that were not fantastic.
Yes, and in your previous episode that you just did, they were talking about slowing of the consumer. As consumption patterns decelerate, as COVID relief spend down continues, it's going to affect the lower income as well as the middle income consumer. Macy's may be more exposed to that than one would like. Hence the reason why if you have a lot of debt and you have a contracting top line, any type of economic impulse on the downside could have deleterious effects on this company.
So what could have good effects? As always, we look at the other side of this.
Oh, absolutely.
Maybe they delever the balance sheet. What would that even look like?
Well, they would have to delever it quite a bit. They do have some very interesting properties that a private equity firm may be more attracted to. They may have to take a company like this private, clean it up over a decade to then bring it back out there into the market. But this is a very tough business to be in. And when you have a lot of leverage, a lot of debt, and you don't have pricing that's very sensitive to outside competition, then you're really setting yourself up for a tough go.
Gotcha. Okay. And you do not have a position
No, we do
in
not.
Macy's. So again, you're recommending folks take a look at Tractor Supply. Avoid Macy's in this environment. Thanks, Chad. Appreciate it. Have a great weekend. And thank you for watching Goodbye or Goodbye. We'll be bringing you new episodes next week at 3:30 p.m. Eastern. Jared?
And let's get to some of our calls of the day. Monness Crespi Hart downgrading Palantir to a sell. The note saying the company's rally gives rise to a gluttonous valuation. And I got some more choice quotes here from analyst Brian White, saying the downgrade comes after a, quote, dismal earnings season for enterprise software. Also failed to live up to the 18-month Gen AI propaganda cycle. So I think some biases might be revealed right there.
Yeah. But he also, one of the things he says is that we have not seen the Gen AI nirvana, in his words, propagated by the enterprise software industry. He said that's proven to be a revenue illusion this year, that the boost that we have seen for some of these enterprise software companies has not necessarily been from Gen AI in terms of the actual revenue growth. A couple other things to note about Palantir here. The stock is up about 39% this year, but for Wall Street, unusually negative sentiment from sell-side analysts. There are 5 buys, 8 holds, 7 sells, including this new one from White. And, we tend to talk about how bullish the street tends to be in general.
Yes.
It's rare for them to have sell ratings. So to have 7 sells on a stock is pretty rare.
It's also a very highly charged stock. It's a Peter Thiel enterprise, so politics get involved. I'm not entirely surprised, but you're right. It's very good to point out that Wall Street typically is much more bullish on these software enterprise plays. Let's go to the Wi-Fi Interactive real quick where I'll chart it. $30 per share is a critical level here. And what I'm seeing, so this is the IPO, this is that initial spike, and we might be tracing out a head and shoulders bottom here. If that's the case, then you take a measured move from the bottom of that to the top and probably puts us around $45, $50 if we can break above, but it looks to me like the pattern is incomplete and it's going to take a little bit more backing and filling to complete that.
Interesting. Shall we talk about a golden arches pattern next?
Oh, please.
Let's do it.
Upside down golden arches.
Let's talk about McDonald's. UBS coming out with a new note today on the fast food chain as the value meal wars rage on. UBS breaking it down if it will translate to the traffic McDonald's is looking for. And Dennis Geiger over at UBS says yes, he thinks that the company will see a boost. He says for the next few quarters, there should be some pressure on same-store sales trends, but then he says sequentially things will start to improve throughout 2024. I also thought it was interesting. He did say that the $5 meal deal, which McDonald's is about to kick off, could drive a 200 basis point same-store sales lift. He also says he expects it to become permanent. Right now, McDonald's is just rolling out the value menu, the new value offerings on a sort of provisional basis, temporary basis, but he says there should be a permanent value platform launching later in 2024.
I would say temporary until you get to the next level. That used to be a dollar menu. Now, I guess the next step is what, $25, $100?
Well, now, $5.
It just takes a few more QE cycles, right? In 2035, maybe we'll get there. I did want to go to the Wi-Fi Interactive real quickly here. I have our QSR, that's fast casual and fast food heat map. This is a year-to-date look, and you're going to see a lot of red here. And let me sort by equal rate so you can see we got some clear winners. Chipotle, Domino's Pizza, Shake Shack, that's 40% down to 20%. But for the most part, and Yum Brands also in the green there, but for the most part, we're seeing a lot more red than green. And some of these names are pretty big, not just McDonald's, but Starbucks in there as well.
Yeah,
it's 17%.
It's been a rough year for some of these names. Let's also talk about gasoline prices. Since it's officially summer, temperatures might be rising across much of the country, but gas prices are not, at least not yet. Joining us now, Patrick DeHaan, Gas Buddy, Head of Petroleum Analysis. Patrick, always great to see you. We have seen, not today, but we have seen oil prices start to creep back up over the past couple of weeks. What's the sort of lag time where we're maybe going to see it make its way into gasoline prices.
Yeah, and great to be back with you. We've seen gasoline prices stabilize. That is, they probably would have fallen another 10 or 15 cents. But as you mentioned, the price of oil has heated back up here, up about $8 a barrel in the last few weeks. And so instead of causing gas prices to immediately go up, some of this is simply gas prices aren't going to go down as much and then go right back up. So I think we'll probably level out here somewhere right around the 340s, 345. There are still a majority of states that are falling, but I do expect that would probably wrap up here in the next few days. And then we'll start to see prices stabilize. So for now, I know it's kind of funky that oil prices go up. Don't expect gasoline prices to make much of a jump yet. We'll have to see oil prices climb a little bit more to see the national average start to have more of a reaction.
And Patrick, also an election year, gas prices a huge election issue. Any levers we might expect to get pulled to affect gas prices to the downside, most likely. But sometimes we see these things in election year. Maybe the SPR, the Strategic Petroleum Reserve, is tapped. Unlikely, I understand, to do that this year. But all in all, does Biden have any levers here?
Not a whole lot. I think talk is cheap, and that may be something that the administration utilizes. That is, they may hint at a potential SPR reserve just because the psychology of potentially offering the SPR may be enough to keep oil prices under somewhat of a pressure, somewhat under balance. But as you mentioned, I don't think that's a tool that the government will necessarily utilize. It also sets a dangerous precedent to use a strategic reserve as a strategic price reduction tool instead of a strategic petroleum reserve. The good news is, though, the SPR has continued to now see increases. The Department of Energy had accelerated a plan to buy back oil. Of course, that's now fizzled with the oil prices north of $80 a barrel. But again, the president really doesn't have a whole lot of mechanisms here, especially considering Mother Nature. We are starting to see some areas out in the Atlantic, in the Gulf of Mexico, off Florida, that just kind of make us remember that hurricane season is rather going to be very active, and that could be a wild card.
Yeah, definitely could, Patrick. I'm also curious for your take on demand right now. We're kind of past the height of the revenge travel phenomenon, but it feels like demand for travel is still relatively strong here. What are you seeing? What kind of patterns are you seeing? And especially, I'm curious about regional patterns.
Well, regionality is certainly very interesting out in the West, where gasoline prices, arguably California, Oregon, Washington, to be more expensive. We tend to see a little bit more of demand destruction there. Now, I would certainly classify demand so far this summer as being a bit soft. That is, while the Department of Energy, the EIA's metric, that is implied demand, measures how gasoline moves towards the pump, it doesn't measure how gasoline is dispensed at the retail level. That's where Gas Buddy data comes in and shines. Now, according to our Gas Buddy demand data, we've seen real demand at the pump essentially be under 9 million barrels a day. And compared to back in 2019 and 2018, that's very soft. Traditionally, we'd see numbers somewhere more in the mid to upper 9 million barrel a day range. So I think demand is still soft. And I think to your point, COVID is still playing a role. We saw a lot of revenge travel in 2022. That's when international travel really wasn't possible. Last year, we saw gasoline prices lower. I think we still saw revenge travel domestically last year. I think this year, we're still seeing some of that revenge travel. But I think now, with airfares down compared to last year, a lot of that is not on the roads, but in the skies overseas.
Obligatory question about OPEC Plus here. We don't expect any big changes on a month-to-month basis, but sometimes they happen. Anything you see that could move the needle with OPEC Plus?
Well, again, going back to talk is cheap. We've seen OPEC, come out with some salacious statements about potentially, hinting at further cuts. But I think OPEC is pretty happy with the way oil prices have bounced back up. Now, global oil inventories do remain on the tighter side of things. OPEC is probably hoping that summer driving season really comes in stronger than expected. But, OPEC certainly could drop comments to keep oil prices range bound. We've kind of been in this now, $75 to $85 a barrel without much of a breakout. I think the interesting thing, by the way, about those OPEC meetings here a couple of weeks ago was highlighting when oil production would start coming back online. So kind of interesting development there.
All right, we got to leave it there, but thank you for stopping by here, Patrick. And up next, Penn Entertainment could be getting a big-time buyout offer. What a possible deal could mean for the gambling company and its investors. Up next.
Are you intrigued by the final frontier? You're not alone. But the space race isn't just about landing on the moon or even tourism for the wealthiest people in the world. It has the potential to gather and distribute vast amount of data, and it could even be a manufacturing hub for your favorite products. We'll chat with advocates and enthusiasts about why space is a real investment destination. From Starlink's biggest competitors to the perils of space junk, we'll bring you top insights. Join us for Yahoo Finance's Space Race, Investing in the Final Frontier. Don't miss our exclusive coverage starting June 24th.
The gambling world may be getting a bit smaller. Reuters reporting that casino operator Boyd Gaming is looking to acquire Penn Entertainment. And if a deal goes through, it would be the biggest merger for that space in nearly 5 years. We're looking at how to navigate the gaming landscape with the Yahoo Finance playbook. With us now to discuss, Jordan Bender, Citizens JMP Senior Equity Research Analyst. Jordan, thanks for being here. I guess I should start with whether you think the deal is going to happen at all, because it seems like there is a fair bit of skepticism out there that this is realistic.
Yeah, this is a super interesting time for the company. Really, it started last summer when Penn sold Barstool back to Dave Portnoy and created an alliance with ESPN to form an online gaming company. There's really two parts of the story ever since there. The brick and mortar side of the business, which is one of the largest regional gaming companies in the United States, that's actually been performing pretty well. On the other side of it is this alliance with ESPN and the ability for them to kind of build this business and create a sports betting and iGaming platform. That's where we've been seeing the struggling from the company, and it's really been reflected in the share prices of Penn. they've lost nearly over $4 billion trying to create an online gaming product, again, now with ESPN. And investors are starting to become worrisome about this. And activists are getting involved in the story. And that's what's really driving the noise. And we've had a shareholder letter about 2 weeks ago saying, Penn needs to put itself up for sale. We're kind of over the losses here. There's more value embedded in this business. But on the surface, it sounds good within a sale, but we think it gets a lot more complicated on who are the actual takeout candidates here. Again, there's two parts of this story. Does someone come in and take out the whole business, or do you separate the brick and mortar casinos from the online business? That's when it gets pretty complicated. We're still a little uncertain how that would kind of play out moving forward.
Well, I just want to read you a sentence from your report dated June 4th on Penn. For a buyer of online gaming, history suggests it takes at least several years to build a successful online business, a large amount of capital, and a perfect strategy to run the sports betting and iGaming business together. Perfection is difficult to achieve here. So is that what we're talking about? Some of the parts maybe not there? Like what is the real value in the business? Tech, anything?
Yeah, we don't know exactly what the value in the business is because we just haven't had enough time. So the way that management has positioned this story is before football season, so this upcoming September, we're going to have a fully functioning product, from being able to cross-sell from ESPN, being able to promote to these people and retain them. And we just don't know about that retention part. So we know that, they're able to cross-sell people. We saw that when the app went live, last year. But the real question is, can they retain the people and actually generate a profit? We look at consensus estimates for the company. They'll lose about $500 million this year, and that'll be about $100 million next year. And, we just don't know, in a potential takeout scenario, what is the actual value that a suitor or someone that's looking to buy this business actually, trying to get out of this business? Because, we just don't know quite yet.
Well, on the flip side, you have a market perform rating on Penn, but you do have an outperform rating, I believe, on Boyd. So what makes it attractive, and would it even need to buy a Penn to continue to be attractive?
The reason we're skeptical, at least on Boyd buying Penn, is Boyd has been overly conservative, especially through COVID and kind of post-COVID. They haven't made any large investments. They haven't done really M&A, and they really haven't jumped into the online gaming space. And for Boyd to go look to buy Penn, this would be a complete 180 of strategy. We think, in this scenario, if, we don't really know how it's going to play out, but if they do buy the brick and mortar business, they'll become the largest regional gaming operator in the United States. If they keep the online business, they'll have a fully, functioning or fully capable business of running an online platform. But, again, that is just a complete change in strategy. You would need the board, you need management, you need shareholders behind that. And it would be an extremely complicated transaction, just given some of the REITs involved. And again, the question marks with the online business still floating around.
And just speaking of the online business, I'm wondering, we saw a huge push, and this dates back to the pandemic and pre-pandemic. We saw a huge push at the state level to approve gambling. And I'm just wondering, on a regulatory basis, how does Penn fit into the picture where you have these two behemoths that really dominate, DraftKings and FanDuel?
Yeah, and that's the core of all this, is you've had two companies, FanDuel and DraftKings, that essentially dominated the online gaming space since it was legalized back in 2018. So that's part of, if you want to call it the problem here, is Penn is trying to build something that they're 5, 6, 7 years behind the leaders in this space who have all the data, all the people, all the technology, and they're trying to do this in such a short period of time. And you mentioned earlier in this that it takes 4 or 5 years really to build up a good business, and that's what DraftKings did. They spent, but they actually built the product, where Penn is trying to shorten that time frame, do this in about a year timeline, and try and prove itself. So it's incredibly competitive, and that's why we haven't seen success from them. Their market share as it stands today is about below 3% of the U.S., where the top two players are around 75% of the U.S. And to go back to that comment of they spent over $4 billion, it's got them under 2% market share. investors just aren't happy with that, and that's why we're getting calls for the company to put itself up for sale.
Right. And Jordan, just quickly here, in your coverage universe, what would be your top pick in gaming?
Yeah, we like Flutter. They actually just listed their primary listing here in the U.S. That's FanDuel's parent company. That would be, one of the dominant players in the online gaming industry. We like scale, we like diversification. This is one of the global leaders in online gaming, and I think there's a lot of advantages when you have scale in this industry. It's a very mature business outside of the U.S., so the ability to kind of acquire and acquire customers and businesses and grow in that aspect, we think it's an extremely attractive part of the online ecosystem to own.
All right. Thanks a lot, Jordan. Have a great weekend.
Thank you.
Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. And that's the closing bell on Wall Street. Now it is Market Domination Overtime. Let's get you up to speed on the action from today's session. So if we look, Jared, at the major averages.
Yes.
Can we describe the session as meh? Not a lot of action here, not a lot of movement in today's session. And it feels like a holiday shortened trading week. I have to check the final numbers because it is. I have to check the final numbers on volume because it's a triple witching day. So you tend to see more volume today.
You'll see a lot of that reported in about 15 minutes. I would wait a few minutes for that to come out. But yeah, it should be a multiple of the highest volume, the existing highest volume day of the year. You got that big S&P rebalance. So XLK is getting a bunch of Apple sold and a bunch of Nvidia bought. That's going to come into effect Monday. Then you've got options expiration.
Yes.
We still got individual stock options expiring after the close here on that last tick. And if we go to the Wi-Fi Interactive, I'll just show you something really interesting. This touches on what we already talked about. The Dow is up about 1.5% this week. That's 4 days. And guess what? The Nasdaq, just about flat. So really a whole lot of nothing. And they've been kind of moving opposite each other recently. So just more of that dynamic here. Real quick, I'll touch on the sector action. And here we see consumer discretionary in the lead up about 84 basis points, then communication services, healthcare to the downside. Energy took a little tumble there. That's in a week that WTI crude popped over 80. We're going to be talking about that in about 30 minutes. But aside from that, it's a quiet end to a relatively quiet week, but a big institutional day here in terms of volume.
And I'm seeing at the end here, at least right now, we're running more than double for the S&P 500, the average over the past 100 days. So not compared to the last witching, because really people who watch this stuff said it was probably going to be comparable to some of the other big witching days that we have seen.
And rebalance days.
Yeah,
and
exactly.
When they happen on the same day, even more.
There's a lot, yes. Well, stocks closing near the flat line as the tech-led rally shows some signs of fatigue, while investors also assess the broader health of the economy and the path for interest rates. Here to discuss all of it is Nancy Tengler, CEO and CIO of Laffer Tengler Investments. Good to see you, Nancy.
Thanks for having me, Julie.
So I know that you guys, I want to start with tech and that sort of divergence that Jared was just highlighting. I know you like some big tech names, but I am curious if you're seeing those signs of fatigue as something that are going to last a little more, or is it just brief?
I mean, I actually hope, because this is the way the market works, that we get a correction that will clear out kind of all the rubble. We get 10% every 12 months on average, and we haven't had one for a while. So I think it would be good for markets, but I don't know that we're going to see that.
What's the catalyst for that? I mean, it could be the Fed, and we'll get to, you got some really interesting comments about the Fed I want to get to, but what is the catalyst for a correction here?
I think when all the hedgies go to the Hamptons.
And that hasn't happened, or is that in process?
I think
it's a little early, yeah.
There'll just be a lack of, it'll be a buyer strike. And I think, that makes sense if you're a short-term focused trader like the hedge fund and algo guys are. We're long-term investors, so we use that volatility as an opportunity to step in, as we did in the fall of 22 and the fall of 23. Certainly there's names we've been trimming, but I still like the trade. My analogy has been pretty clear back to the 90s when I was managing money. I don't think either one of you were born yet, but
that's very kind of you, Nancy.
But it was a productivity-fueled growth run, and I think a lot of similarities: higher inflation, above 3% for the decade. 10 years between 5 and 7%, labor shortage.
Doesn't matter what the Fed does.
Inverted yield curve didn't matter what the Fed did, and so I think that we are there, and we're not at the 1999 end of the decade. We're in the middle of the decade. We've been writing about this for over a year, and I think a lot of other people are starting to join in on that chorus, which I don't know if that's good or bad, but.
So does it matter what the Fed does?
No.
No, just full stop. It doesn't matter what the Fed does. Why not?
Because if they cut, and I think they probably will, they're going to cut once, maybe twice, and there's really no major movement in that. And so when you go back to the 90s, Chairman Greenspan understood what productivity did for inflation. And so he raised aggressively in 94, he cut twice in 95, once in early 96, and then let it ride for a couple of years. And I think that's why I believe higher interest rates and robust stock performance can coexist.
You're talking about Greenspan. That was the age of irrational exuberance. Sometime around there is when he coined the phrase.
Yep.
But you're talking about the current Fed, and I love what you're titling one of your notes here. Data dependent is the new transitory. Has the Fed just stepped in it here again?
I've been so critical. I'm starting to get pushback, but I think, they waited too long. We know that, to raise rates, and then they flip-flop on so many issues. And I thought the really interesting parallel was Christine Lagarde at her press conference was, she must have said data dependent 20 times. She also raised the inflation estimates and cut interest rates. And their primary criterion for cutting rates was if wages rolled over, but they actually went up. And we're kind of in that same environment here, where at the last press conference, the chairman said, 2.6 to 2.7 isn't a bad place to be in regards to inflation. That to me was a cue. And then the press conference before that, he talked about, if labor softens, we're gonna get in there and act. And labor is rolling over. So I think they are itching to cut.
Yes.
They raised their inflation estimate too for this year and next year, but the cut's still on the table. So I think Fed speak is not worth
parsing.
Yes.
A hill of beans?
Yeah, and maybe a hill of beans. Like, you shouldn't let it drive your portfolio decisions.
So something you also said in this note that it was interesting, because Mohamed El-Arian, it's also been a refrain of his, is he also thinks the data dependence is too backward looking.
Yeah.
And he's looking at what companies are saying and listening to conference calls, which I know you were doing also.
Yes.
So what's your takeaway from what companies are saying?
Oh, I love being on his team.
It's a good place to be, by and large.
He's always right. So what we've been hearing is beat, and raise. And not across the board, because certainly there were companies got nailed, but generally speaking, across sectors, and so it matters which companies you own, which management teams you're betting on. But we saw from the companies, especially in our 12 best ideas portfolio, so think Chipotle, think, now of course I'm not gonna be able to think, well, Microsoft beat and maintained. Amazon beat and raised. And so we had a number across segments that Goldman beat and raised. So these are in our 12 best ideas portfolios. But then outside of that, in industrials we saw it, in some consumer discretion. So there are a lot of opportunities to make money if you're buying companies that are growing earnings.
And your investment thesis, your theme has been investing in old economy companies that have pivoted to digitization, cloud computing, generative AI, cloud computing, and the suppliers of the picks and shovels. So that's kind of what we're talking about here. How far does this go? What's the logical conclusion of this?
Well, it's been our theme for 2 years, and so somebody said to me, well, you haven't changed very much, and we don't. I mean, these are long-term secular tailwinds. So think about Walmart and the improvement that they've seen in margins, in same-store sales comps, in earnings growth, and it's been driven by digitization for sure, robotics, also generative AI in their advertising business, and then e-commerce, of course, cloud computing there. Same with Amazon. So you can go across old economy companies, and Emerson Electric is another one of our holdings that is automating data centers and industrial complexes. You can look at Carrier, that's going to cool those data centers that are getting built like crazy, and you can also look at a company like Quanta Services, which we own, which is building the infrastructure for the electrical utility expansion. I mean, I could go on forever, but these are companies that have pivoted, and those are the ones we want to own. So I want to own a Walmart over a Target, for example.
Yeah, a lot of good ideas for people. I'm curious though, as we talk, you're not worried about the Fed, upsetting the apple cart. What are you worried about? Because it sounds like you're pretty bullish here. So what's?
I'm worried about the consumer, and in our ETF TGLR, we reduced our exposure to discretionary names because we think, and we reshuffled it a little bit. I think the low-end consumer and even the mid-range consumer is getting squeezed. If you're a non-managerial worker, it takes you 71.5 hours to pay your mortgage every month. Your average hourly earnings have gone down. Your savings rate has gone down to 3.6% versus 6.1 pre-pandemic. Credit is becoming hard to find. But what may happen, and we saw it with the industrial production numbers, you may see the manufacturing side of the economy pick up some of the slack a little bit.
Why, if all of this is happening, why hasn't inflation come down more?
Oh, it's so sticky. So housing is on its way back up. And I think it's because of the fiscal spending at the government level. It's really fueled the flames of inflation.
But the fiscal spending, we're over that, aren't? I mean, why aren't we over that? I guess.
Yeah, well,
question.
there's a lot that still hasn't been spent, and I think it's embedded. Like if you've got the Treasury financing huge amounts of debt at the short end of the yield curve, that increases and sucks capital out of the regular economy by having to service the debt. We're going to pay $870 billion, according to the CBO, to service debt this year. That means it's going to be probably $1 trillion because their estimates are always wrong. So that becomes another factor because companies are still spending. In our clean energy infrastructure strategy, we've got companies spending like crazy on manufacturing construction's at a historical peak. We've never seen it this high. That creates a multiplier effect in the economy, and I think it's going to continue. And last thing I'll say is, if the Fed doesn't cut rates, housing is going to continue to be constrained, and the prices of equivalent rent is going to go up as well as housing prices.
Yeah, my rent just got increased by 20%, so I'm right there. Yeah, seriously.
And it's cumulative, right? So you've got like in Arizona, where I spent half the year, you've got home insurance prices have gone up 62%. Mine have gone up closer to 80 since January of 2020. So to your point, it's cumulative, it's embedded, and that's why I think it's going to stay sticky for a while.
Nancy, really great to have you here on a Friday afternoon and talk Greenspan as well. So thank you. The first presidential debate is now underway, under a week away, and the economy will no doubt be a topic of discussion. Joining us now is Yahoo Finance's own Rick Newman. Rick, the latest edition of Bidenomics. Where are we going with this one?
Well, I looked at the latest debt outlook that the congressional budget put out this week. This hardly ever makes headlines anymore, but look, the budget outlook only gets worse. It never gets better. So back in February, when they last updated this data, they thought the deficit for the year we're in, 2024, would be $1.5 trillion. Guess what? It went up. Now they think the deficit will be $1.9 trillion. And you've got Biden and Trump kind of flinging mud at each other on this issue. Biden, when that news came out, Biden said, well, Trump just wants to make everything worse. He wants to extend these tax cuts for billionaires and millionaires that would add another $4 trillion to the national debt. Biden said, I have a plan, and he pointed to his plan. But the fact is, Biden had the same plan in 2020 and in 2021 and 22, when Democrats controlled Congress, and those tax increases he wanted to put in place, he couldn't get that done. And by the way, Biden also, by slashing, canceling student debt by $150 billion this year, all of that money just got tacked onto the national debt. So we've got politicians. I mean, Washington is just filled with politicians who give this issue lip service, but there is nobody who wants to solve this problem. The reason they don't want to solve the problem is it's going to be an unhappy solution, and voters are going to punish them when their taxes go up or their benefits get cut. So everybody hates this problem, but there's nobody who really wants to solve it.
And Rick, we were just talking to Nancy Tengler about, that there are also sort of inflationary implications of this as well. So you would think that would be a little bit of a motivator.
Well, the inflation implications of debt and debt financing are complicated. And voters basically look at the price of gas and they say, I'm happy or I'm unhappy with the guy who's in power. And it's just easier. I mean, if you go back 10 or 15 years or even 20, there were people who, many people, serious economists, finance experts, and politicians who said, if we were churning out the amount of debt that the Treasury is printing right now, markets would rebel and we would never be able to get away with it as a country. Well, it has turned out we are getting away with it. The market just keeps absorbing way more U.S. debt in the form of Treasury securities than I think anybody ever thought was possible 10 or 20 years ago. So the market is enabling what are basically terrible fiscal habits. Some president is going to have to deal with this. The solutions are not that complicated. It's going to be a combination of tax increases and benefit cuts. But nobody wants to suggest those things or try to put them in place before it's absolutely necessary because voters don't want to hear it. So we're all to blame for this mess.
Well, maybe a president in 2050 or 2075 or 3000.
Well, the way to think about it, the market is going to force a solution. We just don't know when it's going to happen.
Yeah, right.
And until the market does force politicians to do something, they will not do anything at all.
Yeah, I think I'm calling 2100 at this point. Thanks a lot, Rick. Appreciate it.
That's optimistic, Julie.
The tech-led rally is showing some signs of fatigue as the trading week comes to a close. We'll dial into what's ahead for the mega cap names and AI darling Nvidia specifically. More market domination overtime coming up. While Tesla shareholders may have voted to give CEO Elon Musk a pay package that could be worth as much as $56 billion, a Delaware court could have other thoughts. Here with the latest, Yahoo Finance's own Alexis Keenan. Of course, this vote was an attempt to circumvent or maybe annul the decision of the Delaware court, but we still don't know if that is going to work.
Right. So what we're seeing today are additional filings from both Tesla's side, Musk's side, and the shareholders that were able to win that case and get the $56 billion pay package rescinded. And we're seeing some light on what the arguments are going to look like. But also, this is a very procedurally complex case because this is really unusual the way this is happening. Because if you ask the shareholders' attorney, they would say, well, this vote that happened last week has no legal impact at all because you can't have shareholders overruling a U.S. court, a U.S. judge. They say no legal impact, that judgment should stand. On the other hand, you have Tesla arguing in its court documents saying that it wants the Delaware court, the Chancery Court that made that call, before it issues a final judgment, before it tells the lawyers how much it's going to get paid, to ask the parties to do expedited briefing, tell the court why the shareholder vote should amend everything that happened in that court order and that why Elon Musk should get his pay package today worth about $48 billion. Now remember, 72% of the disinterested shareholders last week voted to approve this award. But there's a big accounting issue too for Tesla. If Tesla is able to get this approved by the court, and we're not saying that's going to happen, that maybe the judge will say, hey, not my purview, this is going up, and Tesla will have to appeal, or the other party, the shareholders, will have to appeal to the Delaware Supreme Court. But $2.5 billion in accounting for this deal back in 2018 when it was first awarded versus what Tesla has said in its securities filings would look more like a minimum of $25 billion to do it in today's dollars. So a lot of uncertainty swirling around here. Also, just want to read briefly a part of Tesla's argument here. They say the voting shareholders that supported ratification included some of the most sophisticated institutional investors in the world, including BlackRock and Vanguard. They go on to note that Vanguard, 7% owner in Tesla shares, said no the last time around. And now that the light is shining on this issue, they have had a change of heart. So a lot to follow here, still legally, procedurally, just a very complex case, and the judge has a lot of decisions to make on her own of how she's going to address these issues going forward.
All right, we got to leave it there, but really appreciate that update and a saga that will continue. We know that much.
That's for sure.
All right, thank you, Alexis. And Microsoft closing the week back on the throne as the most valuable company. Microsoft competing with Nvidia and Apple recently, with many wondering who will hold on to the top market cap spot. For more on what investors should be looking for in the tech sector, we're bringing in Ivana Delaveska, founder and CIO of Spear Invest. So lay it out for us here.
Thanks for having me, guys. So we think that mega caps drove the first leg of this upturn this year. And as we get into the second half, we think the upturn will broaden to mid-cap stocks. So that's where we're really looking most for opportunities. We still like Nvidia. We still see a lot of upside, but we don't think it's going to be as outsized of a performer compared to the rest of our portfolio as we look into second half.
So why do you think that that is the case?
So if you look at valuation, within the mega cap sector, we've seen valuations actually expand. So while the recovery has been driven mostly by earnings, by now we're starting to see some valuation expansion as well. On the mid-cap side, we're actually, like within the software space, for example, we are actually seeing multiples close to the bottom of 2020 and 2022 when we really saw interest rates spike and the whole tech sector collapse. So multiples are still pretty depressed in that space compared to mega caps where they don't look expensive, but they're definitely much more reasonable.
Could you tell us some names here, these mid-cap names in software that you're looking at, and why you think software has been lagging the semiconductor space over the last few months?
So first of all, it does make a lot of sense that cyclicals usually lead us out of a downturn. So that's where you're going to see the first investment take place. You first need to invest in hardware. And then as you get further into the cycle, you're going to be investing in applications and tools. And that's where you really use the software to build these applications and tools. So we would expect a lag usually to occur of like 6 months to almost a year sometimes. But it has been actually very unusual, and it is driven by interest rates trickling up, that valuations have been really impacted in the software space. So the key will be to see the 10-year stabilize at a level. It doesn't really matter if it's 3.5%, 4%, or 4.5%. The key is for it just not to keep moving up. Exactly, and continue to create a headwind. So as soon as we see this stabilize, that will provide a good floor for the software stock valuation, and then it's going to come back to earnings. And then specifically about sectors, cybersecurity is one space that we're particularly excited about because fundamentals are really improving by the day. You're hearing of cyber attacks and ransomware pretty much on a daily basis of large companies getting affected. So that's the area that we're mostly focused on.
I want to get your reaction to a note that we talked about earlier, which was a downgrade of Palantir that talked about the analyst called it a gluttonous valuation, but also said that software is maybe not going to see this strength that you're talking about, in part because the Gen AI revenue huge increases for software have not really materialized. And I'm just curious to get your thoughts on that.
Well, the revenues haven't really materialized because of the lag that I was talking about before. So I think it's really going to take some time for companies. Right now, all of the investment is on the hardware side. So you see all the hyperscalers invest billions of dollars just in the hardware itself. As companies build the applications, that's when you will see the impact on the software side. I think there is a lot of thesis as the stocks haven't performed as well. A lot of people are talking about, well, will Gen AI replace all of these software tools? No, that's not how it works. You really can't build anything without cybersecurity protection, right? You really can't build anything without some of these data infrastructure tools and access to LLM models. So all of these are really important tools. They're just gonna see the impact a little further into the tech recovery cycle.
Anything further downstream that you wouldn't make an investment in right now, but you're thinking, all right, in 3 years, let's take a look at this, a longer investment thesis?
So absolutely, the application layer would be the furthest out. So first we're seeing the hardware, then you see this middle layer of infrastructure, which is cybersecurity, data infrastructure. That's where we're looking to invest in for the next year. And then as you look further, you're going to see the application layer, which is actual applications.
The public-facing stuff that we know.
That's right. So this would be like, beneficiaries would be companies like CRM systems that provide tools maybe that will optimize your sales force. It could be companies like Tesla that offer robots or autonomous driving. So all of these are applications of AI that have not really gained scale and are still in a little bit in a proof of concept stage.
Yeah, that's really interesting. I can say anecdotally, it makes a lot of sense that they haven't seen the productivity gains yet. And Salesforce, Tesla, maybe in 3 years, get that boost. Ivana, thank you for dropping by here.
Thanks.
And that's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton, and for the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. In this holiday-shortened week, technology stocks have more or less been in control of the markets, and not always for the better. Shares of Nvidia slid again in today's session, bringing the S&P 500 down with it, though the broader index did manage to notch a winning streak. We're less than 2 months away from Tesla's robotaxi unveiling. Longtime bull Dan Ives from Wedbush calling the event a key historical moment for the company. But Tesla isn't the only name in the self-driving space. We're talking to the founder of an Nvidia-backed autonomy company next. And those looking for signs of economic weakness had plenty of data to bolster this week as the Fed looks for more signs of progress in its fight against inflation. It's been a bumpy road for many self-driving vehicle startups, but Waabi approaches the tech differently. The autonomous vehicle startup is deploying generative AI in its quest to launch driverless trucks by 2025, and big tech is taking notice. Earlier this week, the company raised $200 million from investors, including Uber, Nvidia, and Volvo's venture wing. Joining me now, the CEO of Waabi, Raquel Urtasun. Raquel, thank you so much for being here. So, first of all, congratulations on the raise. Talk to us a little bit about what Waabi does and how you're differentiating from some of the other autonomous vehicle companies out there.
Yeah, thanks, Julie, for having me here. So if you look at the industry today, particularly in self-driving trucking, the industry has consolidated to a very engineer approach, what we call AV 1.0, that really has difficulty solving the problem. It's very capital intensive. And what Waabi is doing is bringing the revolution of generative AI to the physical world. And that's what give us a very significant advantage in terms of how quickly we can actually build and deploy this technology, as well as being super capital efficient compared to the rest of the competition.
And so how does the training exactly work of the software that you're using to get to autonomy?
Yeah, so Waabi has created a new generation of foundation models that are able to understand and interpret what they see, be able to create abstractions that are interpretable so that you can validate and verify the system, and then uses those abstractions to reason, something that for the first time, foundational models could not do before. And this gives the system the abilities to really generalize to the unknown, which is fundamental when you want to bring this type of technology to the physical world. So that is very data efficient as well. It's very efficient in terms of computation on the vehicle, and it's provably safe. You can think of it as we solve the alignment problem that you see in traditional, more transformer-like architectures that you see on the large language model side of things. And the way that we train the system is mostly on simulation, where we create kind of next generation, also generative AI technology, so that we can expose the system to all the safety critical situations, including accidents, etc. And when we put the system in the real world, it's already much more performant than anything that you see out there.
Raquel, we were just showing Waabi trucks on the road. Do you guys, but you guys don't make the trucks, right? You are making the software that goes into the trucks. How does that sort of melding work?
Yeah, so we integrate our sensors and compute. So we don't build the sensors themselves, but we actually package them in a way that is very, built so that it's very easy to integrate at the factory line with the OEM. So we partner with the OEMs, and then our technology can be very robustly deployed in the physical world. And then the biggest, I will say, differentiator is the software that drives the trucks. For the first time, is generative AI that can really do, with an end-to-end system, as I mentioned, that is interpretable, right? Something that is kind of like the next frontier for the industry that has, really give us this competitive advantage compared to anybody else.
Raquel, we've been talking about autonomous driving for a while now. We've heard people like Elon Musk promise it for a while. And yes, as I mentioned, we're supposed to be getting this announcement later this summer. We'll see exactly what that announcement entailed. Why is it so hard to crack? And are we really closer, not just at Waabi, but at other entities? Are we really getting closer to cracking it?
Yeah, and yes, for context, I spent almost 2 decades now working in self-driving, right? And And the problem has been really that the approaches that the industry had utilized to solve self-driving were very hand engineered, were actually not scalable, that really had difficulty generalizing to the unknown. And there are so many things that can happen in the physical world as you drive that these systems were really are having more and more difficulties to make progress towards the goal. So that it's been a technology problem so far. And the reason I started the company 3 years ago is that being at the forefront of innovation, and really saw that the industry needed a different approach. That kind of approach that will be scalable will come from an AI-first approach. And really unleashing the full power of AI to build a single AI system that can actually really solve this task. And what we see today is that 3 years in, this technology is so powerful. And you've seen the revolution, I would say, in the digital world with ChatGPT in November 22, and all the different things that we have seen from other companies afterwards. And the same kind of, we are at the cusp of a revolution in the physical world, and this is not possible prior to this technology. So definitely what you're going to see now is Wabi deploying driverless next year, our commercial product. And the other thing that we have also for the first time made public is that we're going to do many more things than just tracking. We're going to do other robots with different form factors, whether it's robotaxis, whether it's warehouse robotics, whether it's humanoids. Will be things that we will be doing in this future, and all thanks to this groundbreaking technology.
Well, we will keep in touch as you make all those developments. Raquel, thank you very much.
Thank you.
Don't go anywhere, and we're asking for a trend on the other side. The major indices ending the week little changed as tech stocks remain in the spotlight. Yahoo Finance's Jared Bluke is here with more of his trading day takeaways. And we start with record tech flows, which is so interesting to me because you wouldn't know it by the price action this week.
No, and it's sometimes you see a bunch of flows, but the price, you might see a lot of selling kind of disguised in there. And this is the highest volume day of the year, or it should be right now. I haven't calculated the final tallies, but if you wanted to sell a lot of tech, and guess what? Apple was sold to a tune of $10 billion a day to make room for Nvidia and XLK. Well, this would be the week to do it. Now, the reporting is from the last 5 days, so I believe that stretches back to last week. But here's that spike. This goes back all the way to 2016, 2017, and this is $8.7 billion. Michael Hartnett's team that tracks these flows is calling it AI capitulation. That implies an ending of some sort, but the topping is a process. So one thing I'm interested in is the fact that seasonality, and I showed this the other day with Josh, seasonality favors the bulls the first 10 days of July, and that's just market wide. But I'm thinking if you're looking for a summer lull, you might look for it after that July stretch.
Well, I was going to say too, again, capitulation implies different price action than we've been seeing.
But I think capitulation can mean different things. You can see, like at the bottom of a bear market, you'll see a stock do this. It just plunges, and then it rebounds. That's a capitulation of a different sort, but you can have an exhaustion, I think, of buying that ends in capitulation with a kind of, an uptick even.
Interesting. Okay. Let's also talk about commodities, shall we?
WTI crude punches above $80 a barrel. So let's bring up a chart here. This is going to be WTI crude futures year to date. And here's the pattern that I'm interested in. This is the $80 price level. We're spending some time below that, punched above. Now we've come down. The next logical move is takeoff, but you need a catalyst. So what could be a catalyst? Well, we were just talking to a guest earlier. Hurricane season right around the corner. OPEC Plus not likely to move the needle, but they could. Biden could try to pull a lever in the election year. These things happen, but I think hurricane risk is actually probably underappreciated right now. Positioning in the oil market is very low, so that just means the potential to go higher is there. Finally, we have XLE, and I'll put a line chart here, multi-decade highs, and you can see this high kind of in line with this high, kind of in line with this high. Takes a while to put these 16-year patterns in play, but my question for the viewers is what happens if we punch above here? But I'll show you another chart. Here's WTI crude futures. Energy can be very range-bound because the stock price, a lot of those gains are returned to the shareholder in the form of dividends and also buybacks.
Interesting. Well, not good news.
Dividends mainly.
For drivers, perhaps, potentially this summer, but we'll see about that. And then finally, we talk about, it's got to be Nvidia. Does Nvidia, are we like, as Josh likes to joke, we are contractually obligated to speak about Nvidia on the show? We're not really, but it seems to go that way. Yes.
All right, so let me bring up Nvidia here. I guess this is going to be a max chart. That is a parabola if I've ever seen one. But I want to focus on the price action here. A lot of attention is on this candle. That's from yesterday. That was that big red candle.
What did you call it earlier?
A bearish engulfing, because it engulfs the entire body of the previous candle. Hard to see there, it's really small. Plus, I drew over it, but it reminds me of this price action right here. That was in March. This was a record high. We got that big red candle, and then we kind of backed and filled for a few months. So if you're a big Nvidia fan, at the very least, maybe this sets up a potential buying opportunity. Not right now necessarily, but in the coming weeks. I would also add that with options expiration today, half of the gamma, that's a very wonky term, rolled off, but the net effect for investors next week is that Nvidia is going to trade more freely. When you have high gamma, that just kind of mutes the volatility. There is a trend to the upside, but we'll see things differently next week.
And we'll talk about Nvidia again.
You bet.
Thanks a lot, Jared. Coming up, it's What to Watch on Monday. I'll tell you everything you need to know to kickstart your trading week. Stay tuned. We've got more Asking for a Trend on the other side. while the market is keenly focused on Federal Reserve moves and Fed speak, we rarely get a look at a day in the life of members of the Federal Reserve. Yahoo Finance's Jennifer Schonberger had a chance to sit down with Boston Fed President Susan Collins earlier this week to get a glimpse at her day-to-day life.
Susan Collins is one of the most powerful people in America. The president of the Federal Reserve Bank of Boston, the first woman of color to hold that position, belongs to a select committee in Washington, D.C. that decides whether interest rates should go up, down, or stay the same. We had an exclusive peek into how she makes decisions that influence what you pay to borrow money for a home, car, or what a bank pays you to open a savings account. The Fed has held rates at a 23-year high in the range of 5.25% to 5.5% for nearly a year as it tries to tame inflation. And right now, Collins and her colleagues at the Fed are wrestling with a vexing question. Has inflation cooled enough from its pandemic highs to start cutting rates?
We're going to have to let the data really tell us when it's clear that we're sustainably on a path. And that means looking at a wide range of data.
In June, the Federal Reserve opted to hold interest rates steady in the battle to bring down inflation. It signaled just one interest rate cut this year. Part of the decision for setting interest rates is from information gleaned by regional Fed bank presidents on the ground in towns and cities across their districts, like this one in the 1st District, which spans 6 states from Maine to Connecticut. Collins monitors key data from the Personal Consumption Expenditures Index to the monthly jobs report for clues on the direction of inflation and the economy. But it's also important for her to talk to local businesses, banks, and consumers to see if the official data line up with what she's hearing on the ground.
A lot of the data is telling us what happened last month or last quarter. And when we talk to people, they're telling us what they're seeing right now. They're telling us about their plans and how they see things evolving. And so that's one thing that's important. It also helps to kind of flesh out what the data are telling.
We were invited to follow Collins around for the day in Lawrence, Massachusetts, a former textile town 28 miles north of Boston that's seeing a renaissance. Collins started her day hearing from a local group of bankers and real estate developers who discussed how investments made in refurbishing low-income neighborhoods have fueled the local economy's redevelopment over the past 10 years.
Why don't we start with introductions? Let's go around the table.
She went on to hear about the impact inflation is having on local businesses and the desire for lower rates.
The cost of living is getting out of control, and the rent is something, let me tell you, extremely out of control, extremely out of control.
One of my key takeaways was really understanding some of the challenges that the higher inflation that we had endured is creating, especially for smaller businesses. And the fact that labor markets are actually improving. It's getting easier for people to hire, and there's much less turnover.
Despite the Fed's dual mandate of promoting maximum employment and stable prices, inflation has been the greater focus for the Fed as it's opted to hold interest rates steady while other central banks have started cutting rates. After a scare earlier this year that inflation may be stalling or reaccelerating in the first quarter, the latest readings confirm prices aren't accelerating but may be moving down slower than thought.
It's inflation. We're all consumers at the end of the day. We all buy food at the end of the day. And our biggest challenge over the past 3 years has been, how do we provide a high quality product at a price that people are willing to pay?
The data suggests an economy with demand and supply coming into better balance, which is what's required in order to restore price stability. But this process may just take more time than previously thought. It's too soon to tell whether inflation is durably on a path back to 2%.
What Collins and her colleagues watch closely is the Fed's preferred inflation gauge, the so-called Core Personal Consumption Expenditures Index. It showed inflation grew at 2.8% year over year as of April, a level unchanged from March. Another measure of inflation, the more popularly cited Consumer Price Index on a core basis, rose 3.4% in May, cooling from the 3.6% increase seen in April and 3.8% in March. Both are still above the Fed's 2% target. Jonathan Isaacson is CEO of Gemline, a business based in Lawrence which prints custom logos for companies on a variety of swag, from bags to hats and even coolers. Gemline is one of the largest employers in the city, and IXIC says he hasn't been able to push through price increases to customers.
The time of being able to just hand off price changes is now over from our perspective. During COVID, we did pass through a number of price changes and everybody understood it. Today, things seem to have normalized and people just aren't accepting it anymore.
For economists, that's one of the first indicators that inflation is likely to gradually come down.
I think the data that we have seen recently in terms of CPI, in terms of the producer prices, is consistent with an economy that in an orderly way is becoming better aligned. But we also first quarter saw news that was more disappointing, and the inflation numbers in particular, but other data as well, those monthly numbers are really volatile. The volatility is still quite elevated. And so I do think we have to be patient.
Collins and her Fed colleagues don't expect to lower rates until they gain greater confidence that inflation is moving sustainably toward their 2% target.
Is September too premature to think about cutting rates? Are we looking at something later in the year, more like November, December?
I think we're going to have to let the data tell us. So it seems to me that there are very plausible scenarios where we, later in the year, it would be appropriate if we see strong, continued good news on inflation and an economy that is aligning.
Are you looking at 1 or 2 rate cuts at this point, given where things are?
I could imagine scenarios that would be consistent with both. I mean, I think that as I look forward, my view of how much easing might be appropriate this year has been reduced as I looked at the data.
Collins is also watching for any signs of a slowing economy, which would help the argument for lower rates. The official data indicate the economy may be cooling. Growth in the first quarter slowed to 1.3% from 3.4%. But on the ground in Lawrence, Julie Thurlow, CEO of Reading Cooperative Bank and chair of the American Bankers Association, says the economy looks resilient based on demand for loans outside of housing.
I'm optimistic that a soft landing is in our future. We still see demand. Consumers are still spending. Interest rates are high, but I think it's more of a structural problem that we have as far as housing is concerned.
Collins says she sees a solid economy overall that's showing healthy signs of cooling.
What I see in the statistical data is certainly evidence that the economy is coming into better balance. There's been some slowing in demand, but an economy that's still solid. But it's still quite mixed. There are differences across sectors, there are differences across regions. And what I heard today, it's very consistent with that in the sense of some firms that are still seeing quite strong demand and others where they're seeing consumers being a bit more cautious in terms of their spending.
What's the risk that in the quest to gain confidence that inflation is dropping sustainably back to 2%, that you hold rates at current levels so long that you sow the seeds of a recession?
So the risks are absolutely two-sided, and both sides of our mandate are top of mind for me. So I do think that there is a risk that if we held too long, we would see more slowdown than we need. And that's something that I watch carefully. I think that labor markets are still strong. I think they are not overheated the way that I would have described them earlier, but continuing to watch what's happened across a range of indicators in that space is also important in terms of the timing that will be appropriate to change the stance.
So the soft landing still in place?
Well, I continue to be that realistic optimistic that we're going to bring that inflation down, but we're going to do it amid a labor market that stays quite healthy. And, lots of uncertainty around that, but I still see that possibility as being very much the path that I believe and hope we're on.
Time now for what to watch next week. Starting off with the economy, the latest data on personal consumption expenditures, that's also known as PCE, the Fed's preferred inflation gauge. It's out Friday morning. Economists forecast both core PCE and PCE overall to decline month over month in May compared to April. Moving over to the Federal Reserve itself, we'll be getting another round of commentary throughout the week from Fed officials. This coming after a slew of Fed commentary in recent days. Boston Fed President Susan Collins telling Yahoo Finance that she sees a scenario in which we could see 1 or 2 rate cuts later this year. And as for earnings, investors can expect to hear quarterly results from names like FedEx, Carnival, Micron, Nike, General Mills, and BlackBerry. Finally, on Thursday, President Joe Biden will face off against former President Donald Trump in their first debate for the 2024 presidential race. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night and a great weekend.